This scalping trading strategy has the capability to double your account size, and it is so easy to learn. It combines two powerful indicators on TradingView, and the buy and sell signals that we get from them have an accuracy of more than at least 70%. Let's get started. I'm going to be using TradingView to explain this strategy. I'm going to be quickly explaining the two indicators we will use in this strategy, how you can use these indicators together, and how you can maximize your profits. It's all in this video. So let's start with the first step, adding and revealing the indicators used in this scalping strategy. So in TradingView, I will be using a 5-minute time frame on a Euro-USD chart to explain this strategy. The first indicator is the Kernel regression indicator. These are momentum indicators and help to identify the direction of the trend and potential reversal points. You can open the Indicators tab from here. First of all, we will search for Coine Kernel Regressions in the search box. After that, we have to click on Coine Kernel Regressions indicator created by Quantra Systems option. The Coine Kernel Regressions indicator is a tool used by traders to smooth out price movements on a chart and highlight the overall trend of the market. It works by looking at a group of nearby price points and giving more importance, or weight, to the points that are closer to the current price, while gradually paying less attention to points that are farther away. This smooth line helps reduce the noise caused by small, random price changes, making it easier to see trends and potential turning points. Traders often use the CKR line to decide when to buy or sell. For example, if the price moves above the line, it might suggest a good time to buy. If the price falls below the line, it could mean it's time to sell. The indicator can also act as a guide for support and resistance, showing levels where the price might bounce or reverse. While it's a powerful tool for simplifying market trends, it might lag a little behind fast-moving changes, so it's best used alongside other indicators. So, for that reason, we will add the second indicator of the strategy to the chart.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
Again, we will open the Indicators tab. We will search Fibonacci Bands in the search box. After that, we have to click on Fibonacci Bands by Big Beluga. It's going to be this one. So add it to the chart, and the trading chart setup is complete. The Fibonacci Bands, created by Big Beluga, is a unique indicator used in trading to identify potential support and resistance levels in the market. They're based on the Fibonacci sequence. I'm sure you all are aware of that. In short, these ratios are widely believed to represent key levels where prices are likely to react, either bouncing back or breaking through. Here's how to read this indicator. The central line represents the average price over a specific period, which acts as the baseline for the bands. We are going to be using this baseline in our strategy. The upper and lower bands are then calculated using Fibonacci ratios applied to the price's volatility. The result is a set of bands that expand or contract based on market movement. When the market is trending strongly, the bands widen. During quieter times, the bands come closer together. Traders use Fibonacci bands to predict where the price might reverse or continue its movement. For example, if the price approaches an upper band, it might indicate that the market is overbought and due for a pullback. Conversely, if the price nears a lower band, it might suggest an oversold condition and a potential upward move. These green and red circles are sort of buy and sell signals from this indicator, and we are going to be using these also in our strategy. Now it's time to interpret the signals they provide. We are going to test this strategy on 5-minute Euro-USD chart, as I have also shared before. So for a buy trade, when the Fibonacci Bands indicator has given us buy signals like these, we will wait for the price to move above the center line. And when the market crosses above the middle level of Fibonacci Bands, we will confirm this signal with the help of the Kernel regression indicator. To confirm a buy signal, it should be light blue in color. If these conditions are fulfilled, then you can place a buy order. The stop loss can be placed at the second last Fibonacci line, which is this one, and the risk to reward ratio will be 1 to 1.5. Let's see if the take profit target will be hit. Let's look at another buy example where this strategy gives us a perfect signal. On the chart, notice how we got buy signal from the indicator here, and then the price crosses above the middle level of the Fibonacci bands. At the same time, the Kernel regression indicator's fast line turned sky blue, confirming upward momentum. This alignment of signals is exactly what we're looking for. So we place a buy order right here. The stop loss goes at the second last level of the Fibonacci bands to protect our position, and we aim for a 1 to 1.5 risk to reward ratio. As the trade progresses, the price continues to move upward, hitting our target profit with precision. This is another clear example of how effective this strategy can be. Moving forward here, we got another buy opportunity that meets all the criteria of our strategy. Over here, we got a buy signal, and the price broke above the middle Fibonacci band, and the Kernel regression line immediately was blue in color, confirming the bullish trend. This is our confirmation to enter a buy trade. We place the stop loss just at the second last Fibonacci band level to keep our risk in check. For the profit target, again, we stick to our 1 to 1.5 risk to reward ratio. These examples show how combining these two indicators can consistently identify high probability trades. Notice how waiting for the alignment of signals reduces the chances of false entries and improves our overall accuracy. Now let's move on to a sell trade example. For a sell trade, first of all, we want sell signals like this from our indicator. After that, we will wait for the price to cross and close below the center line of the Fibonacci indicator, just like it did here. And finally, to confirm this signal, we want the Kernel regression indicator to be purple in color, exactly like it is here. So we can easily enter a sell trade here. The stop loss will be set at the second line of the Fibonacci indicator, which is this one right here, and the take profit will remain the same 1.5. Let's see if this would be a successful trade right here. Now, let's go through some other sell trade examples. Here's another sell trade opportunity. Over here, the price breaks below the middle Fibonacci band. And here you can see we got sell signals before that. And the Kernel regression indicator line turns pink, confirming a strong bearish trend. But still, the position ended in a loss. So of course there are losing trades as well. But majorly, these examples clearly show how this strategy consistently identifies profitable opportunities in both bullish and bearish market conditions. In this scenario, we got sell signals right here, and then price crosses below the middle Fibonacci band, signaling downward momentum. At the same time, the Kernel regression line turns pink, confirming a bearish trend. With these conditions met, we place a sell order right here. The stop loss is placed at the second level of the Fibonacci bands, and we target a 1 to 1.5 risk to reward ratio. As the market continues to drop, the price reaches our profit target, making this a successful trade. As we can clearly see that most of these trades offer way more profit than 1.5 risk to reward ratio. We have also got positions that give us more than 3 to 1 risk to reward ratio. So that's amazing. So make sure to backtest the strategy before using it in your live trading. That is going to be it for today's video. I'll see you guys in the next video.